Good afternoon, everybody, and welcome to KPMG's Lunch and Learn series. Today, we're going to talk to capital allowances, how to ensure they are maximized and compliant. My name is Ken Hardy. I'm a tax partner, and I'm a chartered quantity surveyor. I'm joined today by two of my colleagues, also surveyors, Richard Barry and Brian Kevins. Richard will speak to us about wear and tear allowances, what they are, how you're entitled to claim them, what is plant and machinery, and what is eligible expenditure. Brian will talk about industrial buildings allowances, what they are, what your entitlement is, and what eligible expenditure is. Each year, over 382,000 claims for capital allowances are filed through the tax system at a total value of 9.45 billion euros. So this is a very important relief and one that we find taxpayers don't pay sufficient attention to. Each year, we look at a number of different construction types where capital expenditure is incurred. For example, we look at factories, we look at pharmaceutical facilities, med device, biotech. We look at shops and retail, shopping centers. We specialize in particular in commercial offices, where we look at shell and core construction for developers and fit outs for tenants. We also look at the buy-to-let market, be it standalone dwellings or apartment blocks. There's also specialty expenditure that we examine, power plants, oil storage and distribution facilities, grain silos, dry docks, and even petrol filling stations. So we'll bring you through all of that during our presentation today. And with that, I'll hand over to Richard.
Thank you, Ken. We will now discuss wear and tear allowances, or WTAs, available on qualifying plant and machinery, covering the basic entitlement criteria claimants must satisfy in order to claim both conventional WTAs and plant and machinery and accelerated WTAs on energy efficient equipment. We will also consider what is the meaning of plant and machinery and the key plant tests which have evolved over time based on case law, which can be applied when determining whether or not an item is qualifying plant. WTAs are claimed over 8 years at 12.5% on a straight line basis. In order to have an entitlement to claim WTAs, a claimant must satisfy the criteria set out in section 284 of the legislation as summarised below. The claimant must incur capital expenditure on the provision of P&M. The P&M must belong to the claimant. The claimant must be carrying on a trade, and the P&M must be used wholly and exclusively for the purposes of that trade. The claimant must have the burden of wear and tear, and P&M must be in use at the end of the relevant chargeable period, the trigger for starting to claim WTAs. We would note if the claimant is a landlord or a lessor, there are some further entitlement criteria to be met as set out under section 298 of the legislation. We would also highlight under the current Irish regime, accelerated wear and tear allowances, also referred to as ACAs or accelerated capital allowances, are available on capital expenditure incurred on certain qualifying energy efficient equipment. Notably, ACAs may be claimed upfront at 100% in year one. The entitlement criteria for ACAs, as set out under section 285 of the legislation, are similar to the WTAs with a number of specific provisions, such as ACAs are only available to companies operating in Ireland and paying Irish corporation tax and not individuals. The equipment in question must be purchased new and included on the Master Qualifying List of Products as maintained by the SEAI, which is the Sustainability and Energy Authority of Ireland. The energy efficient equipment cannot be leased, let or hired, hence ACAs are not available to landlord or lessors. We will now consider what is the meaning of plant and machinery, how these assets can be identified, and some typical examples. As touched upon earlier, the term plant and machinery is not defined in the Irish tax legislation. The concept of machinery is better understood, and a machine is relatively easily defined as a device incorporating fixed and moving parts. Plant, however, is more difficult to define and is not as easily identified, and in practice covers a wide range of items extending far beyond the obvious movable items. Hence, we must rely on case law and revenue precedent when considering if an item qualifies as plant. Often, both UK and Irish case law are relied upon, and we would note that whilst HMRC precedent is not binding in Ireland, the revenue commissioners here can take comfort from precedent set in the UK. There are several plant tests which are considered when determining if an asset qualifies as plant, such as the function or business use test, the premises or setting test, the completeness test, and the durability test. The function test and business use test are used to ascertain what use the item has in the context of the claimant's business. Where assets have an active function in the claimant's trade, even if affixed to the building, there can be a supportable argument they qualify as plant within the meaning of plant and machinery, as was found in the case of Commissioners of Inland Revenue versus Scottish and Newcastle breweries in the UK. Here, the taxpayer, which carried on a trade of hotel keeping, incurred expenditure on light fittings, associated wiring, and certain decorative items such as wall plaques, tapestries, murals, and sculptures. The CIR found that the electric wiring was part of the fabric of the building and non-qualifying, but found that everything else was qualifying plant and machinery on the basis that the decorative assets were used to create atmosphere or ambience enjoyed by the claimant's customers, which was considered an important function of the company's trade. The premises test is used to ascertain whether or not the asset is part of the premises, and the setting test whether the asset itself plays a part in conducting the trade or is simply part of the decoration of the business premises. In the UK case of Dixon versus Fitch's Garage Limited, a petrol station canopy was found not to be qualifying plant. It was held the petrol could be sold with or without the canopy. The customer's comfort was not essential to the trade carried on. The canopy was considered part of the premises and not plant. A subsequent Irish case, O'Coolacon versus McMullen Brothers, which related to a petrol station canopy also, considered the wider trade and found that the canopy fulfilled a function within this trade, including providing an attractive setting for customers and also advertising, as the canopy bore the illuminated lettering that advertised the presence of the station. Hence, it was held that the canopy was in fact plant and not merely part of the premises or setting. We'd note that the CIR versus Scottish and Newcastle breweries and O'Coolacon versus McMullen Brothers cases demonstrate in concept that setting and plant do not have to be mutually exclusive. The completeness test is used to ascertain whether or not the building itself would be complete without the item under consideration. In a UK case, Cole Brothers Limited versus Philips, a retailer installed an electrical system made up of different elements into a new retail store. The company tried to claim that the entire electrical installation was a single item and it was qualifying plant. It was held that the individual components of the electrical system should be taken into account when considering the correct tax treatment. It was determined that elements such as general lighting and general power sockets merely complete the building and were not qualifying plant. The durability test centres around the question of whether a piece of equipment creates an asset for the enduring benefit of the trade or whether it is a business expense item. The precedent generally quoted in relation to this test is Hinton versus Maiden and Ireland Limited. In this case, a shoemaker's apparatus were held to be capital expenditure in nature as they had a lifespan of greater than 2 years on average. The durability of the asset was sufficient to ensure the expenditure was considered qualifying plant. Hence, in conclusion, when considering a specific fact pattern and whether an item qualifies as plant within the wider meaning of plant and machinery, we need to consider whether the asset has an active function in the taxpayer's trade, or is it merely part of the setting in which the trade is carried on, whether the building or premises would be complete without the item in question, and the longevity or lifespan of the asset. In light of the tests above, we will now touch upon some typical examples of qualifying plant and machinery found within buildings. Examples of qualifying machinery include air conditioning and ventilation installations, sprinkler installations, lifts, heating systems, which would include boilers and heating pipework, etc. Mechanical door ironmongery, which would include handles, cylinder locks, door closers, etc. Some examples of qualifying plant would include carpet finishes, cabinetry or fitted furniture, sanitary ware, demountable partitions dependent on certain facts and circumstances, trade and information signage, blinds and curtains, and loose furniture. Now I will hand you over to my colleague Brian Kevins, who will discuss in further detail some final points of wear and tear allowances, as well as giving an overview of industrial building allowances.
We will now consider what capital expenditure may be allocated to plant and machinery. The direct costs of plant and machinery assets, including transport and installation costs, would normally qualify. There is also the concept of incidental expenditure, items needed for the provision and functioning of plant and machinery. Some examples of this would include concrete plinths which support large items of plant, or in the pharmaceutical setting, steel pipework supports for process pipework, or also builders work in connection with services installations, which you would find typically in construction contracts. There is also indirect costs to be considered, both preliminaries and overheads in relation to contractors within construction contracts, or also design team professional fees, such as architect and project management fees. These can be apportioned appropriately between qualifying and non-qualifying. There is also the concept of expenditure being too distant or too far removed from the provision of plant and machinery, and thus non-qualifying. Examples here would be planning costs or planning fees, certain statutory costs, and also finance or capitalised interest. We will now touch upon common issues which can arise with claiming wear and tear allowances. Sometimes entitlement to claim is not properly supported. This can arise where entitlement criteria are not properly considered and satisfied. This can relate to the review of legal documents such as lease agreements or purchase contracts which need a thorough review. Overclaims can also arise where items of building structure or fabric are mistreated as plant and machinery, or if capital grants or landlord contributions which relate to construction works are not appropriately netted off or deducted in the wear and tear allowances computation. Underclaim scenarios can also arise. An example might be where only the obvious loose items of plant and machinery are identified, and integral plant and machinery within construction contracts, mechanical and electrical packages are not properly identified. This will result in lost tax cash benefit for the taxpayer. Other common issues include insufficient supporting documentation to support claims, correctly identifying the relevant chargeable period that assets were brought into use, the trigger for starting to claim wear and tear allowances, or also ensuring that the qualifying costs allocated to wear and tear allowances are actually incurred and recorded in the claimant's financial statements and accounts. Just to refer to look-back claims, it is possible for taxpayers to open their prior tax returns going back 4 years to amend the capital allowances within under the error or mistake provision. Also in relation to landlord or lessor claims under section 298, we'd also point out that a 24-month time limit can apply in respect of starting to claim wear and tear allowances. We will now consider balancing events in the context of wear and tear allowances. Plant and machinery has an indefinite tax life, unlike industrial buildings allowances. Section 288 of the legislation deals with balancing events and balancing adjustments. In terms of balancing events, there are a number of scenarios where plant and machinery is sold or retired, or where a taxpayer ceases to use the plant and machinery for its trade or rental business, or where the taxpayer's trade or rental business ceases permanently. These would be balancing events under section 288. There are two main types of balancing adjustment where these scenarios arise. Balancing charge would be the first one. This is where the proceeds received for P&M is greater than the tax written down value, and in essence the WTAs claimed are clawed back. Notably, a balancing charge cannot be greater than the wear and tear allowances previously claimed. A balancing allowance arises where the proceeds received for plant and machinery are less than the tax written down value, and wear and tear allowances are granted up to the tax written down value. We will now give an overview of industrial buildings allowances, another capital allowances category under the Irish regime. Under section 268, under the scale back regime, primarily buildings used for the purpose of a trade carried on in a mill or factory, or for the trade of hotel keeping, qualify as industrial buildings or structures. The mill or factory definition has been established through case law. Generally, it is accepted where goods are subject to a process using machinery within the building, the definition should be met. We will now talk about what costs may be allocated to IBAs as qualifying, and also certain entitlement criteria that need to be satisfied. IBAs may be claimed on capital expenditure incurred on the construction of an industrial building or structure. Refurbishment costs would also qualify. Expenditure on land, plant and machinery, or expenditure on which mine development allowances or scientific research allowances are claimed are specifically excluded under section 270. Typically, IBAs are claimed at 4% straight line or over 25 years. In terms of establishing entitlement to IBAs, we'd note the following points. The functional use of the building needs to be considered. If it's an industrial property, is the mill or factory definition satisfied? We'd note if there are non-production areas within the building that do not meet the mill or factory definition under section 268(8, a 10% rule can apply. In application, this means if the construction cost of the non-production areas are less than 10% of the overall construction cost, the entire building may qualify as an industrial building. Other entitlement criteria that need to be satisfied include the claimant must hold the relevant interest in the qualifying building or structure at the time the capex is incurred. Generally, a freehold interest or leasehold interest would be accepted as a relevant interest. The qualifying industrial building or structure must be in use at the end of the relevant chargeable period in order to start claiming IBAs. Lastly, we'd like to point out that industrial buildings and structure have a set 25-year tax life. In the event that the industrial building or structure is disposed of within its tax life, a clawback of the industrial buildings allowances claimed can arise on the taxpayer. If the industrial building or structure is disposed of after its tax life has expired, a clawback shouldn't arise.
Thanks, Brian. So now we've heard about wear and tear allowances, what plant machinery is and what eligible expenditure is. We've heard about industrial buildings allowances, what your entitlement is, what eligible expenditure is. And it's very straightforward to claim these allowances. In your corporation tax return, in your CT1 form, or in your income tax return in your Form 11, all you're required to do is to insert the capital allowances number. No further information is required to be submitted to the revenue. But given the value of these allowances to taxpayers at 9.45 billion, we have certainly noticed an uptick in revenue inquiries into capital allowances, and it's going to be important that taxpayers can substantiate the basis for their claims. I see in the chat function that a number of questions have been raised, and I am conscious of time, so let me run through very quickly a few of those questions. And the first one for you, Richard, and it's one that comes up all the time. Is there a prescribed list of plant machinery that's available for capital allowances?
Thanks, Ken. The short answer is no. The Irish tax legislation does not have a definition of P&M, nor does it have a prescribed list. The understanding of what qualifies as P&M and conventions around treatment have been established over many years of case law and revenue precedent, and it's a complex area. We would be wary of informal P&M lists available in the public domain, and the facts and circumstances of each case need to be considered properly on a first principles basis.
Thanks, Richard. Brian, one for you. Do county council development levies or county council contributions qualify for capital allowances?
Thanks, Ken. An interesting question. The short answer is no. I'd refer back to the concept of expenditure being too far removed or too distant from the provision of plant and machinery. And in this case, development levies and contributions would be treated in that manner.
Thanks, Brian. Another one for you, Richard. Are there any types of companies or entities that are excluded from claiming wear and tear allowances?
Companies paying Irish corporation tax or individuals paying income tax in Ireland may claim capital allowances in their tax returns. However, where special purpose vehicles such as real estate investment trusts or ICAVs are used, which are largely tax exempt, capital allowances are not of real benefit to these types of entities.
And Brian, final question for you. Are we entitled to claim IBAs on capitalised interest on loans used to fund construction?
Revenue have provided guidance on this in their tax briefing number 60, going back to 2005, which included a list of items eligible for industrial buildings allowances. And notably, this point was raised within the eligible list, and interest relating to loans or borrowings to fund directly construction projects or refurbishments may be included within the IBA's computation as qualifying.
Thank you, Brian. I am conscious of time, so can I thank you all for your attention this afternoon. I hope you've learned something new and that today's presentation has been of value. Please do reach out if you have any queries or further questions. Please contact myself, or Richard, or Brian, or your usual KPMG contact. Thanks again for your attention and have a good afternoon.